Okay, well, good morning, everybody. Again, this is David Wayne at American Independent Marketing. It's 9 o'clock straight up. So we're going to start this webinar, and today we're going to do a webinar on Phoenix annuities. And I just got to tell you, I'm sitting here in Yakima, Washington. I'm looking outside, and you can't even see a cloud anywhere. It's just beautiful blue sky out there. Now, if you can discount my drive-in at 34 degrees, it's a gorgeous day outside. So, although I think we're going to get to 57 today. But anyway, on the Phoenix annuity, we are going to go through some of the products that Phoenix has, and we're going to go with one of the more popular annuities that we see going through here with Phoenix is the Personal Retirement Choice. It's actually kind of an exclusive product that is distribution is only to a few organizations, and we are one of the organizations that has this distribution. So we want to make sure that you're aware of it and show you about it. But the reason that we're doing this is because Phoenix has come out with some new crediting strategies that is really exciting. And along with the crediting strategies, some new tools to illustrate that. And we're going to spend the day going through that, the new strategies, and giving you a good understanding of that, and showing you some of the tools to make it easier for you to show your clients how great this can turn out for them. Towards the end, we're also going to do a product that we really haven't shown you guys. I think we've kind of touched on it, but really never really talked about it. It's not in all the states that we do business in, but it is in several of the states. The reason that I like it so much is because it's got a nursing home rider on it and a death benefit all in this product. So guess what? If someone needs nursing home, they can enhance their benefits in their annuity with this rider, and or if someone dies, they get an enhanced death benefit. I have Ed Federici from Phoenix on the phone. He's done webinars for us in the past, and he knows these products like the back of his hand. At least I hope he does. And he does a really good job with these presentations. So what I would like to do is make one last comment, and that is if you have questions, we've got you all muted so we don't get any backgrounds. Towards the end of the webinar, we're going to open it up. Write down your questions, and please ask Ed while we've got him on the phone if you've got any questions that you don't understand or want more clarification on. So with that, Ed, if you could take it from here.
You got it. And thank you, David, and thanks everybody out there. Thanks for thinking of us and your business this year. You've really done a great job, and that's much appreciated from Phoenix, which is located not in Phoenix, but in Hartford, Connecticut. As the weather is getting colder here, I wish more and more that we had a Phoenix, Arizona office. We've labeled what we've just done 4 for 4. So there's 4 big announcements that we've made just recently, all geared for this, kind of finish off to the year in the 4th quarter. But also keep in mind, this is stuff that we're doing to continue momentum into 2015, and a lot of different things had to come into place. I mean, this was, quite frankly, the largest product marketing and program enhancement in our history, all done at the same time. So it involved our actuaries, project team, technology, our operations side, because there have been some form enhancements as well, all done at the same time and just recently announced. So they've done a great job, and I think you're going to be really, really excited with what I'm about to share with you. So those 4 for 4, 2 are specifically related to major bombshell announcements on the product side, including a new partnership for Phoenix. We've enhanced our marketing capability, and then we've also done a great job of streamlining our forms and apps. So let's start with the major news. Okay, Phoenix just announced a partnership with Credit Suisse. Yes, the global organization Credit Suisse. They have created an exclusive proprietary index just for us. No one else has it. So as David mentioned, because of your affiliation with AIM, you have access to one of our exclusive products that a handful of people have access to. Now, not only do you have that, you have this exclusive proprietary access to an index managed by Credit Suisse that nobody else has. So exclusive is one thing, but I think you're going to be really, really impressed with what they've done and the impact for ultimately our end clients. That's what we're here for, right, is to secure their retirement, make their retirement comfortable, and to provide a lot of consumer value through these products. So let's start off. Credit Suisse partnership just announced this new index that they've created. I'll go through a lot of the details in the coming slides, but what you need to know is that we've created 2 new crediting strategies that are linked to this index, and their spread rate. All right, so this provides, of all the cap strategies that we have, this provides the most bang for your buck, the maximum upside through these new spread rates. That's number one. Number two, we have 2 new S&P 500 crediting strategies with participation rates. Now, you may have been on a previous call. These participation rates were only available on one of our products. It's now available across the board. 3, on the marketing front. So while we're doing all this with the products and working with the actuaries, 3, we created a brand new web portal called SalesNet. And it's got product information, operations information, fast facts on suitability. There's also a new section for you, an online My Business tool. So you can actually get at what you've submitted, your pending, you're issued, you're closed. If you work in multiple states, you can sort things by state. You can sort it by product. Brand new, great feedback on that as well. But the major news is what we just did, which we've always had quoting tools, which are critical, I think, in terms of talking about guaranteed income or nursing home benefits or enhanced death benefits. Clients want quotes. They want things that are in the bank, right? But we've also rolled out just recently this brand new illustrative capability that, guess what, takes into account what we've done on the product side. So not only can you talk about it, you can show your clients what we've done and the advantages to them to use these new strategies. Last but not least, streamline application. So one app now. So we used to have multiple apps depending on the product. Now it's one app, select the product, and then there's a rider election form that goes along with it. Now the major news, we're going to go through this product, as David alluded to, at the end. It's called Personal Protection Choice. This is the first time we've talked about it. It's a combo product, and I'll frame it up for you. Like what client would this be good for? How does it work? I'll actually hop out of the PowerPoint, run some quotes and illustrations for you. But the big news here is, as we cleaned up our act on the application side, with that product, as you can imagine, right? There's an income rider, 2 out of 6 ADL home care, nursing home rider, enhanced death benefit. There used to be knockout questions. Have you had a heart attack? Have you had a stroke? Are you on any medications? There was probably up 7 to 10 questions that if the client checked yes, well, guess what? They couldn't get the product. The big news is we've eliminated those knockout questions. I'll repeat that. We've eliminated those knockout questions without dialing back any of the benefits. Now, of course, on the application, you're going to see under suitability, there's 4 key questions. Are you currently in a nursing home? Do you have dementia? Do you have a terminal illness, right? But those knockout questions specifically for personal protection choice are gone. This opens up a huge window for us, and that's why David wanted me to talk about this product as well. So maybe just start with the basics. With a fixed index annuity, folks love them, both agents and clients, and me personally, coming from the asset management world, these are revolutionary products. I mean, these are really good for the consumer. The old saw was that to get at growth of your account and to hedge inflation, you have to be in stocks. You have to be in equities. But think about that. If you're a pre-retiree, a couple years away from retirement, if you're in retirement, can you really risk being in equities? That's the beauty of the fixed index annuity, is the link and participation without any of the downside. So hence the protection is a critical factor. And then guarantees, right? Income being the most popular guarantee selected, but things like, we're going to go through, a nursing home rider, feels like long-term care baked into the annuity, the best enhanced death benefit in the business. Looks like life insurance, it's baked into the annuity. So we're offering lots of flexibility. In addition, there's liquidity. We have penalty-free withdrawals. So what we've done with the new Credit Suisse strategies is we've taken a very rich consumer product, good for the consumer, and we've made it better because we've got some really great options for you to show the growth, but also provide growth for your clients that weren't available just a few short weeks ago. And you know, these are just some of the basics. This is why a fixed index annuity, and this is just the mechanics, right? I found it sometimes helpful just to go through some of the basics. This is in our client brochure, but the point being is that, you know, this is the blue line represents the client's account. The gray line represents the market. So you can see that in a down market, 0 credits are added. The benefit of that is there's no loss to the downside. And as the market goes up, we're adding credits, right? So the client gains and never loses. And then say we're here, right? The market crossed 2,000. Actually set a record this week again, right? After extreme, I think this is actually a good timing for us as well, is after extreme volatility, Dow being down over 300 a couple weeks ago, now setting records, you can point to, well, what if the market's down over 20, which is the technical definition of a bear market? Guess what? Your client's locked in, 0 credits, but at what follows bear markets are bull markets, and the client can participate as well. Now, up to now, some of the crediting strategies out there have been caps, right? So kind of limits. A cap, by its nature, has a limit to it, right? So it kind of limits the upside potential for the client. What I'm about to share with you and what we've done with Credit Suisse, yes, it's not 100% participation. There's a spread, but it really enhances the upside potential and makes this a fantastic story for our clients. And why I think, I kind of alluded to this, this is a great time for us, okay? This is a slide that I created back in the tech bubble, in the 01-02 era. And it was more geared towards the investment side, but retirement in particular. And this is obviously our clients today, our mutual clients today, right? They look at their account values in their 401ks, their IRAs, maybe they have a brokerage account, and they are feeling great. They are feeling like Warren Buffett, and I can't believe this is happening to me. The newspapers are promoting it, right? Stocks set record highs today. Reminder, this is from 01, right? 9 out of 10 forecasters agree great days ahead. This causes complacency. There's an investor behavior called the recency effect. What does that mean? That means our clients take their most recent experience and push it out in the future, like it's going to continue to happen. The end result, this guy's forgotten about the housing bubble. He's forgotten about the worst bear market since the Great Depression. He's forgotten about the tech bubble. He's forgotten that the pool has been drained twice on him in his retirement account. He's just seeing that this is going to just shoot to the moon, okay? And anecdotal evidence here is if you look at the IRA rollover market, okay, this is a sliver of what's out there. It's a big sliver. $393 billion was rolled over in 2012, projected to be close to $600 billion. But there's trillions out there. When somebody does a rollover, where do you think they place their assets? Stock funds, managed accounts, ETFs, individual stocks. 78% of the assets are exposed to the market. So we talked about investor behavior, right? This is proof of that. They've forgotten about the risk. They've forgotten about the volatility. On the other hand, maybe you have some clients who are out there who are terrified, right? They lost 40%. I'm not going to let that happen again. These folks are putting their retirement money, their life savings for retirement, in things like a checking account. So once again, this is a golden moment for us, right, to remind our clients. Now think about it. If we don't have that discussion with them about preparing, and maybe, you know, let's take some risk off the table. Let's take some of those chips off the table. When is the best time to start adding protection? Obviously at a market peak, right? When you're down 40, your account value's shot and your benefit bases become lower. This is an opportune moment for us, and I think made better by the product enhancements that I'm about to go through. So every webinar I talk about this. Always have this 4 corners offense in mind when talking to your client, listening to your client. These are the 4 pillars of that. Accumulation, we just talked about that. Folks have brokerage accounts, 401ks. Setting records, they're feeling great, they're complacent, but they need our help, especially if they're in or near retirement. Income, the most important rider selected most often to guarantee income. But we're going to go through a product that, I know maybe some of you guys focus more on life insurance. Family protection, very important pillar, but it not only applies to life insurance as a vehicle. I mean, you got to do the right thing for your client, but there are annuities that have enhanced death benefits. Care, yes, there's long-term care, but there's also long-term care benefits baked into annuities. So the point is, have that discussion, listen to your clients, and know that through your affiliation with AIM, you get access to some exclusive products and some best-in-class products that allow you to pivot based on what you're hearing. So we're going to spend a moment just going through the high-level product lineup, and then I'm going to hop out of this and get into how we've made these products even better through our partnership and relationship with Credit Suisse. So if your client's saying, I want to keep accumulate, but I want to protect, you have this exclusive personal retirement choice, which has in, not all states, but in most states up to a 15% premium bonus. We talked about this before in Washington and Oregon. It's an 8% premium bonus with some uncapped strategies. And I'll show you, especially going the route of, hey, look, I just want to accumulate. I don't want to use the optional income rider. I think you're going to be blown away with the new results. Our income product, this product, say this product maximizes accumulation, this product maximizes income. So if your client's having a discussion with you and they're not talking about their brokerage accounts and they're talking about, well, when I retire, I know I'm going to have my property taxes, my phone bill is going to be this, my electric bill is going to be this. We spend this much for food, entertainment, we need to heat, and I know what that's going to be. Well, your client's done an income and expense analysis, so they're most likely concerned with or have a high priority set to maximizing their income. And this product has up to a 45% bonus or a staggering 14% simple roll-up to that benefit base to maximize their income. The other product that David wants me to talk about today is personal protection choice. So think about a client that comes to you and says, David, I've kind of done a lousy job here. I have this pretty large rollover, but I don't have a pension. I'm not confident in Social Security. I never bought life insurance, and quite frankly, I don't want to go through underwriting. I never bought a long-term care policy. But I have this rollover. It's a couple $100,000. Well, guess what we have to do? We have to stretch those assets, right? This person may not be right for individualized solutions for multiple different products. Maybe they don't want to. Maybe they're not insurable. We have this product which is called Personal Protection Choice, not available everywhere. So I'm going to caution you, and we'll go into that. But it has an income rider, same like personal income annuity, income today or tomorrow. It has a 2 out of 6 ADL protection. So if the client needs home care, it takes the income and multiplies it by up to 175%. If your client's in worse shape, they're confined to a nursing home, it takes the income and multiplies it up to 250%, payable for up to 5 years. Last but not least, the best enhanced death benefit in the business rolls up at 10% up to age 70, 5% from 71 to 85, and pays out like life insurance, lump sum, no 4-pay or 5-pay. It's a lump sum payout. So that's our product lineup. Let's go through the first part of the news in terms of letting our clients participate in the upside market, right? Let's go beyond the capped strategies. Let's get into uncapped. Let's get into participation rates and spreads, and I'll explain what each means. The point is that we now have across the board, generally speaking, there's a couple of states like California that hasn't approved the new Credit Suisse, but very few and far in between. So I can generally say that across the board, we have 7 available index accounts for you and for your clients. Many relate to the S&P 500 index, like a monthly point-to-point, 1 year. We've now added the 1 and 2 year participation rates. These are new. So we allow, so if market's up, there's a participation rate based on each of these strategies. And I'll share a little bit more in a couple slides. But we are really excited about. Where we're getting all of the kudos and where all the interest lies is what we've done with Credit Suisse. We've had Credit Suisse create an exclusive proprietary index for us. And I'll get into the weeds on that in a minute. And we've created some spread rate point-to-point crediting strategies that link to this new index. Are there other spread rate crediting strategies out there? Yes. Some are 3 and 5 years, so think about that. We were very cognizant of this. Say you select a 3 or 5 year crediting strategy. Every year the client statement's coming, right? Hey David, I got my statement. Market was up. How come I didn't participate? Well, we picked a 3 or 5 year. Next year it rolls around. Hey, I got my statement. How come there's no? You get the picture. So we're very cognizant of that, and very uniquely, we have a 1 year and a 2 year point-to-point with the spread. So I'm going to go through this in the basics. And David, I didn't mention this to you, but if you get me the names of the folks that are on the webinar, they still have to go through product training. But in lieu of, we are not doing special product training on these new index enhancements. You still have to do your NAIC product training. But if you get me the names of the folks that are on the webinar, I will get that over to our compliance area, and they will get credit for being on this webinar relating to the enhancements. Once again, still have to do product training, but this is maybe some of the basics that we'll go through. So, cap account, as it states, right? Maybe you have a product that has a 3% cap. Market does 10. What does the client get? 3%. What if the cap is 4, right? Market does 20. Client's still going to get 4. They're capped. Participation rates, it's a percentage. So like on some of our products, we have a 30% participation rate. Say the market's up 10. They get 3. The market's up 20. They get 6. So you're getting into the uncapped strategies. The spread rate I just describe as a hurdle. The client or the index has to pass a hurdle, and then everything above that is gravy to the client. And this is where in our back testing, in our analysis of this is the way to maximize the upside potential. All 3, there's no downside risk to the client, but kind of in order, this allows the client greater and greater access. Okay? I think it's important, and what I'm going to share with you, I'm going to hop out now. Let's see if there's anything here. S&P, we talked about there's the 5 different strategies. The new are the participation rates, and we talked about Credit Suisse. So before I tell you how they do what they did, let me show you some illustrations of what we've done here. And let me hop in. So this is our brand new SalesNet. As I said, product information, marketing information, your business information. So you are now required to create a login. But as you see, I've created a username and a password. Do it once. Have Safari or Google Chrome remember it for you. So some great information here. And if you go over to Quick Links, that's where our quoting tool is. Now, I've already got that teed up. And we're going to run something for David Wayne here. And we're going to do, let's start with personal retirement choice. Actually, I've run it in advance, but just to show you how easy it is. You plug in your client's name, your name, and let's say we're in Washington. And then you plug in your client's name, their age, their gender. You pick down a product from the drop-down. We're going to go with personal retirement choice. We're going to put in $100 grand to keep it simple. And in this instance, say your client doesn't want the income. They just want to protect and continue to grow the asset. Okay? So there's no charge for the rider if you say no. Okay? And I'm going to show off. And here's where your crediting strategies are available. Credit Suisse 1 year, 2 year, monthly on the S&P, cap, participation rate, fixed account. So this is kind of standard across the board. I'd say each client is different. Would I ever select one strategy like I'm about to do? Maybe, right? So if you got a client that's got some dough and they're telling you, look, I've got a lot of dough in multiple products, multiple vehicles. What I want to do with this is potentially maximize the upside. That would be the only scenario. Otherwise, being, once again, an asset management guy, I like to spread and diversify my options because who knows what strategy is going to be best. So for illustrative purposes, I'm just going to show off the new Credit Suisse product, okay? And you'll see that this is a great-looking illustration. It's very institutional looking. It's loading, by the way. You are seeing a blank screen. It's loading. Very, very institutional looking, very clean. Here's the information we've plugged in on the client: 65, 100 grand, 8%. Here's the crediting strategy that you've selected, and here's a look at the total guaranteed value and the potential for the accumulation value over a 10-year period. Here's a look at the account accumulation potential. So there are some guaranteed values and non-guaranteed values. Let's look at the accumulation. Remember, we're using this Credit Suisse spread brand new index. So at the end of 10 years, this has grown from 100 to $164,000, almost 165. That's incredible for a fixed index annuity. If the client has a longer time frame, we're more than doubling the asset, right? Pretty incredible. We have not selected an income rider, so there's really not a lot of use of going through the income potential, right? So we're saying this is for a client who's looking to maximize the upside. We're getting kudos on this. This is my favorite page or slide of the presentation that you can put in front of a client. Once again, earn some credibility, talk about the worst, the best, and the most recent experience using this index. So here's where we've selected the 2-year Credit Suisse Tactical Multi-Asset Index. And our analytics go back and pull what would the worst 10-year period look like? What has the last 10-year period look like? And what does the best 10-year period look like? Okay? I always like to, once again, I said build your credibility by having a discussion of each, because we just don't know what's going to happen on a go-forward basis, right? So in the worst case scenario, which also happens to match up with the most recent 10-year period, that $100,000 has grown to $164,894. There's a little number underneath this table. Geometric mean, it's an average return rate per year, 4.32%, okay? Best 10-year period, 100 has way more than doubled. The client would be looking at the 10th year, $224,000, almost $225,000. We've more than doubled the asset. That's a return of 7.6% per year. We are now getting into stock market-like returns in a risk-controlled index managed by Credit Suisse. Okay, product summary, definitions. So this is the personal retirement choice, and as you can see, pretty incredible enhancement to this product. It has an 8% premium bonus, optional income rider that would roll up at 8%, and I've just shown you some spectacular numbers gleaned from using the new Credit Suisse strategy. I am going to hop over to our, let's see here. All right, I'm now going to hop over to the other product. Let me go back to the PowerPoint here, just to remind you how this works. So that was personal retirement choice. That's accumulation. We talked about that scenario, client needing to stretch their assets. Personal protection choice, combo product, income, home care, nursing home care, enhanced death benefit, okay? Not available everywhere, so we be careful when after we get off the call. You can go to our web portal. We have a grid of where it's available. But this is a very, very powerful product. It's actually our fastest growing, second best-selling product. So how does this going to work? Okay, so let's go to report. Okay. So with this product, client age 65, $100,000. The other part is you can select different variations of those riders. You don't have to go for all three, right? There's 3 different iterations. But we want income, we want the personal care, and we want the family protection. So guaranteed income, 2 out of 6 ADL or nursing home, and the best enhanced death benefit in the business, and the income's going to be for tomorrow. Once again, I put everything into the 2-year just to show off. You're going to want to diversify this, okay? Just keep trying to keep it simple. So let's go to the guarantees. So this is going to be a quote and an illustration. So if your client decides to turn on income in the 5th year, here's the guaranteed income amount. $7,871. We put in $100,000. What's the percentage? That's a 7.8% GMWB in the 5th year. I tell this story a few weeks back. I was dropping off my daughter to school, heading around and heading towards work, and there's this bank with a huge banner that said celebration rates for CDs, 1.1%. I know rates are down, right? Interest rates are there's some pressure there. 7.87% guaranteed for life. Then let's say in the 10th year, the client is, or let's say 5th year, let's say the 7th year, the client's confined to a nursing home. Okay, their guaranteed income for up to 5 years would be $22,571. So in the 7th year, they hadn't taken this income yet, just to be clear. In the 7th year, they were confined to a nursing home, $22,572. That's a ratchet of 250%. Or say they just needed home care. So that income stream would be increased to $15,800. That's up to 175%. Then we have the family protection all the way over here. You can see it's rolling up at 10% simple. And then when the client turns 71, it's a 5% roll-up, paid as a lump sum to the beneficiaries. Now, great product, right? That's pretty unique. I was just at a conference this week in Houston with some big, very big distributors and carriers, and they were actually bringing up this product, how innovative Phoenix was with their combo product. So we got some kudos in a pretty big setting. So how do we make that product better? We add upside potential. So once again, we're using the 2-year Credit Suisse Tactical Multi-Asset Index. The worst 10 years, the assets have grown from $100,000 to $152,000. That's a 6% annual return. That's dynamite. How does it get better? Well, we got to look at the best 10-year period where $100,000 has doubled, $203,000. That's an 8.87% annualized return. And once again, we're getting into the very high single digits here, right? Stock market-like returns available in a fixed index annuity. So pretty incredible. So I showed you the results. Let me show you how Credit Suisse does this. Okay? So I'm actually going to do this in reverse. Okay? So just to reiterate, Credit Suisse partnered with Phoenix. They have created an exclusive index for us that we now have these 2 strategies that link to this brand new index. It's an actively managed index. It's managed by Credit Suisse. I'm going to start with number 3 first. They are looking to maximize returns, but first manage the risk. So they're going to look at, it's called standard deviation. They're going to look at the volatility, the standard deviation, each and every day to see if it's in line with what they've targeted. If it's not in line, they then have the ability to dynamically reallocate. What does that mean? That means every day they have the ability to change the to change what's in the index. It's limited, so don't be fearful of that. I'm going to go through what they have in their palette of what they can do, but they can dynamically reallocate every single day to manage to that risk number in order to get the most return for that risk. Okay? I asked when we were launching this, I said, okay, there are asset management products out there that the manager has the ability to do that, but in practicality, they're just doing it on a weekly basis or a monthly basis or maybe even a quarterly basis. what's Credit Suisse really going to do in practicality? And the answer was, no, they're looking at this daily, and they will reallocate on a daily basis if there's any deviation from the risk number. This term, rules-based, that means it's a black box. They have algorithms and computer models to tell them what to do based on the volatility. So there's no discretion. There's no portfolio manager saying, you know, I feel like overweighting, you know, a sector today. There's none of that, okay? It's rules-based black box. And it's highly diversified. This is the most diversified option in the marketplace today. They have, from their palette of what to choose from up to 10 ETFs, which cover the biggies, like, you know, equities and fixed income. But they also have access to things like commodities and real estate. And I'm just going to share with you, once again, being in asset management or having a background in asset management product development, I was blown away with this. We have access, and once again, just to be clear, you as an agent are not going in with the client and saying, I want to pick the gold shares. No, you're picking the Credit Suisse index. How do you want that, 1 year or 2, from a spread rate crediting strategy? But Credit Suisse is going to be managing this. How about gold, emerging market equities, international, domestic, emerging market bond, high yield, investment grade bond, treasuries, inflation protected securities, real estate? What I love is things like gold, real estate, tips, high yield, emerging market. Those are what are called non-correlated assets. That means when the market's zigging, these things can zag. So what I love about this, I've just showed you that it's tremendous upside potential, right? Best case, we're more than doubling the client's asset, even in a combo product. But having these non-correlated assets in a sideways market, a flat market, a down market, maybe gold's going to be up. Maybe high yield, which tends to not correlate. Maybe real estate's going to be up. So we have the option to create some return potential for the client, even in a sideways or a down market. Here are the maximum weights for each of the ETFs. Here are the current weights. And there's another risk control, which is asset class limits. So if you were to add these up, this is 60 in equities. They're capping it 40, okay? So that's just another layer of band and controls for the product. We talked about this dynamic reallocation up to a daily basis. Their job is to adjust this daily to get at the highest ratio of return to risk. This is good for our clients. And they're managing volatility daily, so as volatility increases, they decrease exposure or change the mix. As volatility decreases, they'll increase the exposure. Full disclosure here, right? This is a great results with this particular index. The downside of this, because we're managing to risk first, if you have a screaming and raging bull market, an index like this may not experience the highs that have been realized on like an S&P, which is not risk controlled. Okay, just to level set for us. This is historical performance. Once again, it's rules-based. It's a black box. So we've back-tested and back-casted what Credit Suisse has done. And I've shared with you, once again, the quotes here and illustrations, which is part of our news as well. Brand new SalesNet portal, brand new tool. This is the best tool that you can use to get in front of your clients to get them up to speed and excited about this particular product. Let's see here. Still have quotes. So if you just have a client that's looking for income and you don't want to get into this with the client, still have the quoting tool still available. Last but not least, now we talked about this. We have one application. You pick the product on the application, and then there's a rider election form. For that combo product, personal protection choice, new application eliminates the knockout questions that were previously required. So why don't I conclude where we started, which is this is, quite frankly, the largest enhancement that we've made brand new partnership with Credit Suisse. We've enhanced the product offerings through the credit strategies, brand new marketing tools, brand new streamlined apps, and exclusive product available to you that gives you a leg up out in the industry today. I'll just leave. I know we're going to take some questions. If you want to dive into this a little bit deeper, our sales desk is available for you to go through this. If you want them to run an illustration, you want some literature sent out to you, here's the number to call. By the way, our phones have just, when we do these webinars with you guys, the phones just light up. So we really appreciate that. And David, why don't I take a breath, see if there's anything that you wanted to add, and then we can open up for any questions that might be out there.
Okay, well, thank you, Ed. And there are some questions out there that I've seen that have been typed in. One of the questions was, is this approved in, or the personal protection choice approved in Washington? And the answer to that is no. It is not in Washington or Oregon, but it is in several other states. It's available. Another question that was asked is the personal retirement and choice and the income annuity, are they approved in Washington? And yes, that is correct, they are. Another choice is what is the bonus on the personal retirement? It is an 8% in Washington, and in other states, Ed, do you want to explain what the bonus is in other states?
Sure, and it depends on the client's state and whether or not they elect income. So it can be 8%, or it could be 12, or it could be 15. So it's all dependent upon the state. Is there a specific state you wanted me to comment on?
Well, I already mentioned Washington and Oregon are 8%, but if you're using the income rider, the percentage is different. If you don't use the income rider, it's different, isn't it?
Yeah. So let me just go to Arizona. I'm just guessing here, but so if you use personal retirement choice without the rider, they'll get a 12% premium bonus. If you add the income benefit, that premium bonus becomes 15, and the charge for the rider is 95 basis points. So by virtue of paying a little bit more, we're able to give up a little bit more, to give the client a little bit more premium bonus when they do elect the rider. But in states,
go ahead.
Washington, right? Whether you elect the income rider or not, you're still getting an 8% premium bonus.
Okay. I'm going to unmute the phone because we've got a lot of questions. So if you put in your PIN number, you'll be unmuted, and this is a great time to ask questions because we seem to have quite a few. Bear with me. I'm almost there. If you didn't put the PIN number in, yeah, I won't be able to unmute you.
And remember, if we're having a little trouble here with the phones, if you don't want to ask in a public setting, you can give us a call at this number. I'll leave this number up in case we're having any technical difficulties here, and we're happy to help. I mean, we just threw a lot out at you. There's also a Brainshark that has information on this, so it might be helpful. I'll get that to David to pass out to kind of hear it again, and then if you have questions after that, we're happy to help. As I said, this is a lot that we've done in one setting, and kudos to our product and operations team to making this happen all at once.
Does anyone have a question while we have a chance?
How do we answer the question?
Yeah, can you hear
it? We can hear you now.
Okay. What about California? Where do you stand on your riders, and when do you expect the 2 new strategies to be approved in California?
Unknown. I asked that question this week. California's kind of a wild card, unsure as to how long they're going to take. It could be up to a year.
Okay, what's available right now?
Personal income annuity. From a product perspective, personal income annuity. Here, let me hop out. Personal income annuity. Go to California, and I'll show you exactly. I'm going to get out of this product, and we'll go to personal income annuity.
Appreciate it.
Yeah, anytime. Let's see, why am I, oh, you know what? So because in California the Credit Suisse is not available, it's not popping up in here. So let me go back to our regular quoting tool. Bear with me for 1 second here.
Okay, that could be up to a year.
For you. This is what you're looking for. So in California, we have our personal protection choice and personal income annuity. In California, though, just note, personal protection choice only has the income rider and the enhanced death benefit. Their view is that the long-term care rider is insurance, and so they've not approved the long-term care rider in California. So it's only income and the enhanced death benefit for personal protection choice.
Okay.
On the application, do you have to select a single product at the beginning?
Yes, that's correct. So let's see if I can get there as well. Let's get back to that.
Is the contract annuitant or owner-driven?
You know, I don't know. To be honest with you, I don't fill out a lot of the forms. If you called the sales desk, I'm sure they could answer that for you. I'm sorry, I just don't. I just don't know that. Let's go to California.
And Ed, before we go away, let's show that number for the sales desk.
Here. Let's see, annuity application.
Since California doesn't have all of the products, why don't you show us a state maybe like Arizona that does have all of the products so we can look at that? Does that make sense?
Yeah, let's. Oh, I'm sorry, I'm going to the wrong here.
But if you're in California, it doesn't.
Yeah, we all know that work with California, how difficult that state can be, but they do still have that personal retirement annuity, which gives a bonus, which is nice. It's a very strong bonus.
So here's Arizona, and here's what the application looks like. Select the product.
And so once they select that product, that's what they have in perpetuity. Is that correct?
Correct. And then there's a rider election form that goes with it. So as an example, personal income annuity, there's the rider choice is, do you want income today or tomorrow? So there's a rider election form to determine when the client wants to turn on income.
Okay.
Pretty easy materials to work with. The software is great. It's right on their website, which you will have access to once you get contracted. So, and I will supply this list of people that attended to Ed, so
Okay.
that get that credit towards it.
Great, thank you.
Any other questions?
Will that apply for those of us that are not yet licensed but get licensed within the next, say, week or so?
Yep.
So to be clear, if you're not contracted, you can still get at the materials. You can still get at the look at the materials and get going on educating yourself on the product. You still have to go through the NAIC product training. We are just collecting names in lieu of us requiring you to do specific training on the new crediting strategy. In addition, David providing us with this list, I provide that to our back office area so that you get credit for being on quote-unquote training webinar.
Any other questions?
I missed issue ages.
Depends on the product. For the personal retirement choice, 0 to 85. For all other products, I'm sorry, personal retirement choice, 0 to 80. So personal retirement choice, 0 to 80. All other products, 0 to 85.
Okay.
Pretty flexible. Yep, pretty flexible there.
Do you have a spread rate, max spread rate guarantee?
I want to see it's 10.
10. Okay.
It depends.
And,
like it depends on the product. So if you've let's go to, let's see which one did we do here. So on personal retirement choice, the spread is 4.70 on the 1 and even with the 4.70, you know, we got into double the client's assets. And then on, is this personal protection choice? Yeah, so on personal protection choice, the spread is 2.5 and 1.15. So they vary by product.
Is there a maximum that Phoenix can go to?
Yeah, I think it's 10.
I think it's 10. Okay. Okay. What are Phoenix's ratings?
Phoenix is a B carrier by AM Best. There's a let me step back. There's a little bit of a story behind this, where in the midst of the last downturn, we had a relationship with State Farm. We had at the time 38% of our business being done through State Farm. We had a notch downgrade due to some credit impairments due to some hedging mismatches back in 07, 08. Nothing that we needed to get an infusion of capital or TARP money for. And I would say that first notch downgrade was fair and it was justified. And State Farm basically said, guys, this environment is chaos. We're going to have to put you on watch here. So then we had to tell the street that our largest distributor just put us on watch, and the street said, you're going down 2 more. And so we had to tell State Farm, hey, we just went down 2 more, and they said, well, you're going to hold. We had to tell the street that State Farm just put us on hold, and the rating agencies, they said, you're going down more. And then ultimately, over this 16, 18-month period, we went from watch to hold to State Farm. We lost the relationship. And the slide, and it all started with, once again, some hedging mismatches. Not a lot to do with the financial strength of the company. More of us losing State Farm in a very tumultuous time and a time of chaos. And that really was the genesis and the main driver for the rating downgrade. As you all know, insurance companies are incredibly strictly regulated by the state insurance commissioners. We're site of state in both Connecticut and New York. They can come in monthly, quarterly to look at what we have set aside, because obviously they have a vested interest with their state guarantee funds. They want to make sure that we are reserving properly, we have adequate statutory results. So if you were to look at the numbers that back our promises, the numbers that back our guarantees, the statutory results as they're called, we have the financial wherewithal of an A- company. There's a stat called the RBC ratio, risk-based capital. Others call it the solvency ratio, and in essence, it measures for every dollar you have set aside in statutory reserves, what do you have for liabilities? So our RBC ratio is 333%, which means that for every dollar we have out there in liabilities, we have $3.33 set aside. That is of an A- carrier. So I'm giving you a lot of information because at first blush, well, they're B-rated. There's a little bit of history to it, and if you look at the numbers and the financials, the backing is there. In addition, when we launched our fixed index annuity product lineup, we did something that no other carrier has done, and that is we created a separate account. So when your client's assets come into Phoenix, they don't go into the general account, which would be at the risk of general creditors. They go into a separate account that are segregated and held apart from the general account. So quite frankly, we could be C-rated. Those assets are protected. No other carrier has that. And once again, we launched our product lineup in the midst of the chaos of 08 and 09, and we're very cognizant of that. Last but not least, to protect you, also at that same time, being a little bit sensitive, being a formerly A-rated carrier now in the B range, we wanted to protect those people out there representing us. So in addition to the separate account for your clients, all of you are protected by our supplemental E&O, which is not all-encompassing. It's called an embedded supplemental E&O, which guards solely against insolvency. So think about that, the financial wherewithal of Phoenix to go out in 2008 and the worst market since the Great Depression and get insurance, a supplement E&O coverage for you. That just speaks to our financial wherewithal. So as you'll probably hear from David, nothing for you to sign, no cost to you. You're automatically covered representing us.
Any other questions out there? Okay, well, Ed, thank you very much for the webinar. If you guys have further questions or want contracting, send me an email and I'll make sure I'll get it out to you today. And Ed, I'll get that list over to you today. I'll talk to everyone later. Thanks for attending. We'll keep in touch. Thanks.
Awesome. Thank you so much, everybody.
One quick question before you go.
Go ahead.
Yeah. Do you have a PowerPoint or something that we can has been developed that is approved to work with clients?
We do not. Unfortunately, we do. We have client, obviously, brochures and materials and the quoting tool. There's actually a presentation called it's generic, called Plan Right, Retire Right. But unfortunately, on the product side, we had somebody who took a client approved, or actually they took an agent approved and modified it and put it in front of a client. So we don't have we don't have client PowerPoints at this point in time, except for the generic one. And I'll make sure that I get that to David after the call that you can use as well.
Okay. Is that available on a laptop? Your quoting program, is that available on a laptop?
Yeah, the quoting tool is available laptop, iPad. There's actually I didn't get into it. I also conduct a webinar called Geek Squad, but let me just get to this real quick. I think you're gonna like this too. From a generic perspective, right? If you wanted to have a discussion with your clients about I got to log in once again. I'm sorry. If you want to have just a generic discussion with your clients and start collecting data at the same time, we have this software called Realize. Once again, available through our website, which is dynamite. I mean, this has been out for a few years. We were a little bit ahead of our time, but it's like a PowerPoint that tells a story about how retirement used to be and what it's like now. You start collecting information on the client, date of birth, when do they anticipate needing income. I'll go through this quickly to be respectful of your time. The pension landscape has changed. The responsibility has been thrown on you, Mr. or Mrs. Client. You have a pension. What's the value of your 401k? You can start collecting information in dollars. Social Security is uncertain. You're going to live potentially longer than you expected. Inflation. Are you concerned about inflation? Right? We talked about that old saw of being invested in equities, and the reason is to outpace inflation. Is this something that concerns you? Healthcare costs are rising, potentially over $400,000 in your lifetime, especially during retirement. So on and so forth. Do you have CDs? Do you have other fixed annuities? Do you have stocks, bonds? What's your risk tolerance? So you'll see very quickly. I'm going through this very quickly. You can do it as high level, or if you really wanted to get into the weeds, you can get into their monthly expenses, shelter, food, healthcare, transportation, personal insurance, personal care, entertainment, taxes, and by the way, you can do this on a laptop or an iPad. You'll get to our quoting tool. You can print what you've just collected and leave it with the client, or basically you can email it to them as a PDF. So here's what we just went through, and this is what I collected on you, Mr. and Mrs. Client. And everything you've just collected, you can then go to our eApp software. And let me see if this is running. There we go. So you've just told them a story. You've talked about their hopes and fears in retirement, their planning. You've collected data on them. You can see I did this very quickly. 76% of the form is already full. And you can now go and submit everything electronically. So once again, maybe this, David, is a topic for another webinar, but there's some powerful client-facing software available to you above and beyond just the quoting and illustration tool.
Absolutely. We can do something like that later on. Again, if you guys have any further questions, please email me with the questions, or wanting contract or any of this information, please send me an email. It's david.wayne, and the Wayne is spelled W-A-N-E, at YAIM, the word Y, WAWHYAIM.com. So it should read david.wayne at YAIM.com. Well, Ed, again, thank you and everyone for your questions. I appreciate you guys attending this webinar. We'll continue to do these as we go through, and thanks for everyone's attendance. Talk to you later.
Perfect. Morning. Right. Very good.